Welcome to Talking Personal Wealth Management podcast. My name is Leah Crowley, and in this series we're taking a look at a range of topics that you might know a little bit about but want to get a better understanding of. We explore all areas of personal wealth management, including investing, estate planning, financial advisory, self-managed super funds, insurance, and financial life cycles. But today we're going to pick the brain of Andrew Kennedy. He's a risk advisor and part of HLB's insurance services. We're going to talk about when individuals or families should review all of their different insurances. How you going, Andrew?
Not too bad, thank you.
Are you excited that we are so far into 2022 that people have stopped coming to you with like New Year's resolution insurance ideas?
Yes, and I'm also glad that we're no longer asking how everybody's new year is going.
Yeah, that's fair enough. Give us a bit of a background on you and how you got into this risk advisor position.
So I've been a financial advisor for going on 17 years. I've been with HLB Man Judd for close to 15 years, and about 3 years ago I took on the insurance specialist / risk advisor role within HLB. And what we did when we started that up was made a joint venture with one of the biggest insurance firms in the country. And so with their support, I help look after our clients.
Excellent. You must really enjoy it.
I do, yes.
Yeah, I would think so because with risk advising, I mean, as someone who's not a risk advisor, but I would imagine there's so many different angles that people can come to you with problems, or not even problems, just like, am I doing the right thing?
Absolutely, yeah. And there's so many different ways of just looking at even the same problem and different things that you might factor into your decision, situations that you might want to protect, people that you want to look after and all that sort of thing.
Yeah, cool. And we'll dive into that in this episode. Firstly, I think we'll kick it off with a very important question. Why should I bother getting insurance?
Insurance is an important addition to everybody's financial situation because it helps you look after yourself and your family and your business if something goes wrong. When I talk about life insurance, it's typically a medical issue, whether it be an illness or an injury. And effectively what we're doing is ensuring that you and your family still benefit from your ability to earn an income through to retirement if something stops you from being able to do that, whether that's permanently or temporarily.
Yeah, so it's sort of not anticipating for the future, but just preparing for the unknown future.
Insurance is definitely something that you don't want to have to use, but if you don't have it and you need it, you'll wish that you had it.
So what kind of insurance options are there for the individual?
So in the life insurance space, there's 4 main types of insurance. The one that most people would know and understand pretty well is life insurance, and that does what it says on the packet, which is if you die or you suffer a terminal illness, it pays out a lump sum to your family. And that's essentially earmarked to pay down the mortgage if you've still got a mortgage, look after the kids' education, and provide for your family's ongoing expenses when you're not around. The next biggest one that people probably are familiar with through superannuation, for example, is total and permanent disability, otherwise known as TPD.
Yep.
And that is also a lump sum payment similar to life insurance that pays out if you're never able to work again due to illness or injury in an occupation that you're suited to. And it works in a similar way. It looks after debt, looks after education expenses, and just make sure that your ability to earn income is replaced with a passive income source. Another one that a lot of people are familiar with but probably don't understand how it works properly is income protection insurance. Income protection insurance is more looking after your temporary illnesses or injuries. It does pay out through to age 65 if you opt to take that option. But essentially, it helps to put food on the table and pay the bills if you're unable to work for a few months or if you have a significant injury but you're not permanently disabled and able to go back to work again in the future.
I feel like that's the one that we hear a lot about in commercials on TV these days.
Absolutely.
Yeah.
And it can be very complex, and if you don't truly understand what's going on, you can go down the wrong path in the income protection space and end up not having the cover that you need.
So, I mean, how do you cover for, I mean, this is insurance, but how do you cover for the unexpected in this kind of scenario, right? Is it one where it depends on what kind of industry you work in? Does that make an impact?
Definitely the industry that you work on can impact on your ability to get income protection insurance for starters, especially if you're in a very high risk occupation. An example of that would be somebody who uses explosives in underground mining. Mm-hmm. Essentially, you can't get income protection for that. Right through to if you're a high income earning professional working at a desk, that's the ideal sweet spot for most income protection insurers, and you'll pay a lot less of a premium for that than you would if you were a plumber or a tradesperson, for example.
Yeah, no, that makes sense. And there's one last?
There is one more type of insurance, and it's actually, we find it to be the most claimed upon insurance product, but nobody knows about it. It's called trauma insurance, otherwise known as critical illness insurance. And the key thing about that is it actually pays out on diagnosis of a significant illness rather than
diagnosis,
correct,
right.
rather than a work or an inability to work. And so you can be diagnosed with early stage significant cancer, for example, receive a lump sum payment that has nothing to do with whether you're able to go back to work or not. And that gives you the option of being able to say to your employer, I want to take 12 months unpaid leave, for example, while I go through the fairly significant treatment and recovery process that's going to be involved in this, and not have to worry about paying your bills, not have to worry about paying mortgage payments and that sort of thing. And often for trauma insurance, we'll include a little bit of extra cash in there for someone to be able to go and participate in medical trials if that's something they want to look at, or if their treatment is not on PBS, not covered by Medicare, not covered by private health insurance, which unfortunately happens fairly often.
And people probably don't know that, right?
Correct. Yeah.
I would imagine, because those sort of traumatic moments like cancer treatment or something like that, where suddenly everything bad is bad, like you start to panic and your loved ones start to panic as well. This has to take a massive weight off your shoulder, right?
Absolutely. Being able to have 12 months worth of expenses in your bank account with no tax implications and no need to not be working, it gives you so many options.
Yeah. Okay. So they are the big four.
Absolutely. Yep.
That's very important to know. Now, as a small business owner, what kind of life insurance would be relevant for my business?
So as a business owner, there is those 4 insurances that you would obviously want to set up for the personal side of things, but you can also use those insurances to help the business. A big one that we look at is called buy-sell cover. And that's actually a part of the agreement that you would set up when you go into business with a business partner. And the buy-sell insurance is just a funding mechanism to make that happen.
Sure.
Essentially what it means is that there's an agreed upon plan for the business if one of the partners is ill or injured or passes away, and what happens to that ownership of that business, so that you ensure that business continues, so that you ensure you're not suddenly in business with your business partner's spouse who may not have any understanding of how that business runs.
Or interest,
yeah. Exactly. And also it means that spouse is going to receive the values that you expect to have come out of the business. You're not suddenly going to be at a fire sale condition or in a position where a bank's calling in a debt because one of the partners has just passed away. There's money there to pay out the spouse, the family, and to ensure the business can continue.
So it's fair, to make it fair.
That's exactly right. And it's, when you look at the cost of premiums to fund this type of insurance, it's one of the cheapest methods of actually putting that certainty in place for your business and for a company or anything like that. Typically, you're talking less than 0.5% of whatever the sum that you're insuring for a life insurance policy, for example. Other ways that you could use those life insurances, the different types of life insurance for your business, you could use income protection to look after ongoing business expenses, things like rent, overheads, staff expenses, subscriptions, all those sorts of things can go into a business expense policy.
So that the business can keep running.
Exactly.
Yeah.
And it just takes that the cash flow draw out of the equation so that the business's doors can stay open while you go through your recovery and eventually come back. And probably the third one that we tend to look at for businesses is called key person. And what that does is look at a smaller time frame where if a key person wasn't around, say, for example, somebody who handles all of the sales of the business or someone that has the IP in the business, how do we make sure that if they're not around for 12 months, for example, or if they pass away in the most extreme example, how is the business going to be able to recover from that? And what money does it need to make that happen? That could be things like hiring bonuses for a new manager coming in, sales bonuses, and that sort of thing for a sales manager.
Yeah, right.
Or it could be, literally funding costs to go out and obtain new debt or to find a new business owner, like sales costs, agent fees, that sort of thing.
What was that one called again?
That's called key person.
Key person. Okay. That's an
Used to be
interesting
key man, but we now
okay.
call it
Yes.
key person.
I approve 100% now. So let's say we've got all of these insurances in place and we're feeling good about ourselves and our future and the great unknown, right? How often or when should I be looking at reviewing my personal insurances?
If you have insurance in place, you should be reviewing it every probably 2 to 3 years with the person that helped you set it up. There's other key events that will tend to kick off when you need to have a look at it. The big one is having kids. Also, when you take on debt or if you repay your debt, if you change jobs, if you have a large increase in income, or if there's new dependents that you need to look after and that sort of thing. And when I say that, I'm speaking about brothers and sisters, parents that all of a sudden you're now financially obligated for.
Sure. Not necessarily the big life changes in someone's life, but also smaller ones like changing a job. Like that's the thing that you probably wouldn't think about, right? Because you're just busy learning how to do the new job.
That's right. Yeah.
Yeah. Okay. All right. That's good to know. Let's go back to the small business owner again. How often should a small business owner review their insurance?
So that probably depends on how successful their business is. If you're growing revenue or growing the equity in a business significantly year on year, you would probably want to be looking at your insurances that are tied to that valuation every couple of years.
Yeah. Okay.
Particularly buy-sell. Where we've got a buy-sell policy in place for a client, we would be looking to go back to their accountant, have a business valuation done every couple of years. Mm-hmm. Because if they're suddenly worth 50% more than they were when the policy was out,
yeah, good point.
They're underinsured, and that's what we want to avoid.
Yeah. Okay. Yeah. No, that's fair enough. Very sensible. And it's not like super daunting because it's every couple of years, right? It's not you must do it every 3 months, or quarterly.
Exactly.
That's very manageable. Yeah. Speaking of daunted, how complicated is it for an individual to change their life insurance policy from like one insurer to another? Because you might, when reviewing it, go, this is not working for me anymore. Is there a lot of rigmarole?
As an individual with no support through an advisor, it can be. It can be quite complicated to get it through. And you can be distracted by some of the messages that are out there. I call it daytime TV insurance.
Yep.
There's no way of knowing whether that insurance policy that you see in a commercial is the right amount, if it's too much, not enough, whether that's a cost-effective premium, and whether there's any other types of insurances that might even be more important to you than a life insurance policy, for example. Mm. When you've got an advisor, I will take all of that out of the picture. I go and do all of that work for you, and I come back with a recommendation that says, I've considered the entire market. I've looked into the different features and benefits of a policy, how much it's going to cost, and I'm recommending this policy to you as the best combination of quality, price, sustainability, claims experience, administration, ease of dealing with a company.
Oh, that's a good one.
Yeah.
Yeah, that's a really good one. And I would imagine there'd just be so many people out there who are either they've done it themselves and they've underinsured or overinsured themselves.
Yeah, and the other situation there is also the default super insurance. A lot of people go, yeah, I've got insurance through my super, I'm covered.
Sure.
But I couldn't tell you the number of times I've sat down with a client who's earning $200,000 a year, who's got $300,000 worth of life insurance through super. The fact of the matter is they might owe $2 million on a property. $300,000 is not going to get you very far in paying that mortgage off, let alone those kind of people tend to have their kids in private school. If you're talking about a year's, 6 years worth of high school fees in Sydney, that's $200,000 right there.
Yeah.
And then often and this is a generalization, often that person's spouse is probably not fully employed. They'll be either part-time or unemployed, helping with, I say unemployed, they're helping raise the family and look after the house.
But they're not bringing money into
not an income generator.
Yeah.
What are they going to survive on? Are they, if they've been out of the workforce for 10 years, they may have been, a high-flying lawyer before kids came along, but they're now out of the workforce. And they don't have that experience. They're not going to be earning the same amount of money that they were back then.
And they may not get the first job that they go for as well.
Exactly
so it's going to take a bit of time.
Yep.
Yeah. Okay. Interesting. So, I mean, we kind of touched upon this already, but when you do change from one life insurance policy with one company to another, do you run the risk of losing any money? Like, what's the situation there?
So I hate to say this out loud, but ideally you never want to claim on your insurance policy.
Yeah.
And the fact is that if you never claim on your insurance policy, the premiums that you paid to the date of expiry are lost. But the risk of you needing to claim on that insurance and not having the insurance in place, in my opinion, is worth the premiums that you're going to spend. You're never going to be in a position where you're up for money, to having to pay money for an insurance policy that, apart from the premiums, you're not all of a sudden going to have to be funding insurance out of your own pocket when it's time to claim or something like that, unless you were dishonest when you went through the process of applying for the insurance, and the insurer can say, we proved that you didn't tell us everything you needed to tell us, and they go, well, now we're not going to provide you with that full cover, and that's stated up front, and it's gone through up front with the client to make sure that they understand what's going on with that. And all of my clients know that they need to be fully upfront and honest with me when we go through the application process. So that's never a consideration down the track.
Get caught, you get caught, and then it's just not worth it.
You don't want to get to claim time and suddenly find out that you're not actually going to get the insurance that you paid for. That
would be devastating for your loved ones if it is a life insurance. You're just leaving them high and dry. That would be terrible.
That's right.
How common is it that individuals have been paying for insurance on something that is no longer relevant to them, and they don't even realize because it's just paying it? It's
more common than you'd think, and it's got a lot to do with how most people pay for their insurance, and that is through superannuation. The premiums come out of super, and in my experience, most super funds don't show the insurance information until the 6th or 7th page of your statement.
Yeah, right.
And most people aren't still reading when you get to the 6th or 7th page.
Yeah.
So you can be paying for, as I said, I think most people are underinsured, but as you get towards retirement, possibly you're now in a position where you don't need the full amount of cover that you've got. You can be paying for a life insurance premium that you set up when you first had kids, first got a job, first got a mortgage, and no longer need any of that cover if you don't review it. Not continuously, and consistently.
And that's the every couple of years thing. That's where that comes into play. It catches any dead weight insurance kind of policies.
Exactly right. Yeah. What I like to do with my clients is actually, as we go through the review process every couple of years, say you're 2 years closer to retirement, so there's 2 years worth less of income that you need to pay for.
Yeah.
There's 2 years less of school fees that you need to cover.
Yeah.
You've paid your mortgage down, so let's move your insurance to a lower amount so that we're no longer covering for what we were covering 2 years ago. It's almost a reward for going through all those milestones.
That's exactly it.
And we can save them money.
Yeah, what a great way to look at it. So why is it easier to get assistance from a specialist risk advisor like yourself? I mean, I think we kind of have touched on this, but let's just hammer home this idea that it's easier, it's better, it's sensible.
I think what a lot of people don't realize is that insurance advisors and financial advisors in general have a legal obligation to have your best interest at heart. It's enshrined in legislation that we're licensed under. On top of that, we have access to the full market, and we're in the interest of making sure that you're in a policy that suits you, that you're not going to decide in 2 years' time that you want to get rid of. So we're going to be battling for you to make sure that you take out the right insurance policy for you. We're going to make sure that you understand why you're taking it out and what the purpose is. And we're also going to make sure that if you need to go through underwriting with an insurance company, if you've got perhaps some medical issues in the past or currently that need to be assessed by that underwriter, we'll actually present it in the best possible light for that insurance company, so that if you go direct to an insurance company and say, I've got this certain medical condition, they may look at it and go, oh, we're going to exclude that for you from now until eternity.
Yep.
Whereas if you go through a risk advisor, they will actually present that in the best possible light and get an agreement, I think, upfront from the underwriter that says, in a year's time, 2 years' time, we're actually going to review that. And if you're no longer going through treatment, no longer have symptoms, we'll get rid of that exclusion. That's one of the services that we look after.
Yeah, that's really good. And the fact that you guys do this day in, day out, I mean, you know it through and through, where we don't. We're only reviewing it once every couple of years.
Yeah. Most people will go with the insurer that they see the commercial for on TV.
I bet.
And that, I'm not just saying the daytime insurers. There's other all the insurers that advertise on TV, but
you know them all.
That's right. And it's not a marketing decision. It's not a decision that should be governed by a good marketing program.
Oh, that's really well said, Andrew. I really like that. Well, Andrew, thank you so much for coming on and chatting about this. This is super important and stuff that people don't need to necessarily keep the top of their mind, but you need to keep it in the back of your mind so you remember to keep checking in. But I would imagine that because you were part of HLB, because there's a lot of different advisory services on offer, that they can come to you and then you can kind of point them in different directions if they've got other questions.
Absolutely. And not only that, we have access to the client's full financial picture, whether that be through their accounting, whether that be through superannuation or wealth management, whether it's through insurance or mortgages, debt advisory for a commercial client, estate planning. It all works seamlessly, and it's all an integrated relationship that you have with a single advisory firm.
I like the sound of it. Andrew, thank you once again.
Absolutely a pleasure.
Andrew Kennedy's expertise and knowledge is part of HLB Manjudd's personal wealth management services. For further information, please visit our website hlb.com.au.